The Japanese yen, a currency that has a rich history and a significant impact on the global economy. It's a major player on the world currency stage, influencing markets far beyond Japan's borders. But it's known for its wild swings. The yen's value can change dramatically in a short period, making it both a challenge and an opportunity for traders. Up one day, down the next. What gives? This volatility can be attributed to a variety of factors, both domestic and international. Since the 2008 financial crisis, the yen has been on a roller coaster. The crisis shook the global financial system, and the yen's value reflected the turmoil. It surged against the dollar as investors sought safety. During times of uncertainty, the yen is often seen as a safe haven currency, attracting investors looking to protect their assets. Then it weakened as Japan tried to boost its economy. The Japanese government and central bank have implemented various measures to stimulate growth, which can impact the yen's value. Fast forward to today, and the yen is still on the move. Why so volatile? Lots of reasons. Japan's economy, global events, even speculation. They all play a part. The interconnectedness of the global economy means that events in one part of the world can have ripple effects on the yen. Speculation by traders can also lead to rapid changes in the yen's value. When traders anticipate changes in the market, their actions can drive the yen up or down. Buckle up, because we're diving into the wild world of the Japanese yen. We'll explore the factors that influence its value, the strategies traders use to navigate its volatility, and what the future might hold for this fascinating currency. The yen is often called a safe haven currency. What does that even mean? Well, let's break it down. It means when the world gets scary, think financial crises or pandemics, investors flock to the yen. They see it as a reliable and stable currency amidst global turmoil. They see it as a stable place to park their money. This perception is rooted in Japan's strong economic fundamentals and political stability. Think back to the 2008 financial crisis, or the COVID-19 pandemic. The yen shot up. During these times of uncertainty, the yen's value increased significantly as investors sought safety. Investors were nervous, so they bought yen. This influx of demand for the yen drove its value higher. They knew Japan had a stable government and a strong economy. But here's the catch. While the yen's rise can be seen as a vote of confidence in Japan's stability, it also has its downsides. Sometimes the safe haven label can backfire. When the yen strengthens too much, it can create challenges for Japan's economy. When a crisis hits, the yen surges. This surge can make Japanese goods more expensive on the global market. This makes Japanese exports more expensive. As a result, Japanese companies may find it harder to compete internationally. Not good for a country that relies on trade. Japan's economy is heavily dependent on exports, and a strong yen can hurt its trade balance. For instance, Japanese car manufacturers and electronics companies, which are major players in the global market, may see their profits shrink as their products become pricier for foreign buyers. This is why the Japanese government and the Bank of Japan often intervene in the currency markets. They aim to prevent the yen from appreciating too much. They use various tools such as monetary policy adjustments and direct market interventions to manage the yen's value. The goal is to strike a balance, maintaining the yen's status as a safe haven while ensuring it doesn't harm Japan's export-driven economy. On the flip side, a strong yen can benefit Japanese consumers. It makes imported goods cheaper, allowing them to enjoy a higher standard of living. From groceries to electronics, Japanese consumers can buy foreign products at lower prices when the yen is strong. Additionally, Japanese tourists traveling abroad find their money goes further, making international travel more affordable. So, while the yen's role as a safe haven currency has its advantages, it also comes with complexities. It's a double-edged sword that requires careful management. In the end, the yen's journey through safe haven status and market fluctuations reflects the broader dynamics of the global economy. It's a story of resilience, adaptation, and the delicate balance between stability and growth. Safe haven or stormy seas. The yen's tale continues to unfold, shaping the financial landscape in ways both predictable and unexpected. Monetary policy is a fancy way of saying how central banks control money, and it has a big impact on currencies. Japan and the US have very different monetary policies. The US Federal Reserve has been raising interest rates to fight inflation. Japan? Not so much. The Bank of Japan has kept interest rates super low for years. They're trying to stimulate their economy. These different policies create a tug-of-war on the yen. Higher interest rates in the US attract investors. This pushes the dollar up and the yen down. You don't need to be an economist to understand how economic data affects currencies. The value of a currency, like the Japanese yen, is influenced by a variety of economic indicators that reflect the health of a country's economy. These indicators are like pieces of a puzzle that, when put together, give a clear picture of economic performance. Think of it like a report card for a country's economy. Just as students receive grades for their performance in school, countries receive grades based on their economic performance. These grades are reflected in various economic indicators that investors and analysts closely monitor. GDP growth, inflation, trade balance, these are all key indicators. GDP growth shows how much the economy is expanding, inflation indicates the rate at which prices are rising, and the trade balance reveals the difference between exports and imports. Each of these indicators provides valuable insights into the economic health of a country. When these numbers are good, the yen usually strengthens. Positive economic data suggests that the economy is doing well, which boosts investor confidence. As a result, more investors are likely to buy yen, driving up its value. Why? Investors are more confident about Japan's economic future. When the economic outlook is positive, investors feel more secure in their investments, leading to increased demand for the yen. This increased demand pushes the value of the yen higher. But if the data is weak, look out below. Negative economic data can have the opposite effect. If GDP growth slows, inflation rises too quickly, or the trade balance worsens, it can signal trouble for the economy. The yen could weaken as investors get spooked. When investors see signs of economic trouble, they may lose confidence and start selling off their yen holdings. This increased supply of yen in the market can lead to a decrease in its value. It's all about supply and demand. The value of the yen, like any other currency, is determined by the balance between how much people want to buy it and how much they want to sell it. This balance is constantly shifting based on economic data and investor sentiment. When more people want to buy yen, its value goes up. This increased demand can be driven by positive economic data, investor confidence, or other factors that make the yen an attractive investment. When more people want to sell, its value drops. Conversely, if investors lose confidence or if economic data is negative, the increased supply of yen in the market can lead to a decrease in its value. Understanding these dynamics can help you make more informed decisions about currency investments. Remember, the world is interconnected. What happens in one part of the world can impact currencies everywhere, and geopolitical events can really shake things up. Think about the war in Ukraine, or tensions between China and Taiwan. These events create uncertainty in the global markets, and when investors get nervous, they often turn to safe haven currencies like the yen. But here's the thing. The yen can also weaken during geopolitical turmoil, especially if the events directly threaten Japan's economy or trade relationships. Now let's talk about speculation. Speculators are traders who try to profit from short-term price movements. They're like the daredevils of the financial world, always looking for the next big swing. The yen's volatility makes it a prime target for speculators. They buy and sell yen rapidly, trying to ride the waves of its ups and downs. This can amplify the yen's movements, making it even more volatile. Think of it like a roller coaster. Speculators jump on for the thrill of the ride, but their actions can make the ride even wilder for everyone else. So, who wins and who loses in this game of yen volatility? Well, it depends. A weaker yen can be good for Japanese exporters. Their products become cheaper overseas. But a weaker yen also makes imports more expensive for Japanese consumers. That can hurt households and businesses that rely on foreign goods. A strong yen has the opposite effect. It's good for consumers, but can hurt exporters. The bottom line is that yen volatility creates both winners and losers in the Japanese economy. The Japanese yen is a fascinating and complex currency. Its volatility is influenced by a web of factors: Japan's economy, global events, monetary policies, and even market speculation. Understanding these factors can help us make sense of the yen's wild swings, but predicting its future movements is no easy task. The yen, like all major currencies, is subject to the whims of the market. One thing is certain: the yen's volatility will continue to impact Japan and the global economy. So buckle up and get ready for the ride.